Today, we are addressing a pressing concern that millions of Americans are facing: layoffs. In 2024 alone, we saw significant job cuts across various industries. And if you've recently been laid off, you're most likely wondering, what should I do with my 401k? In this video, we're going to dive into the current state of layoffs, as well as some ideas on what you should be doing with your retirement savings following a job loss. Stick with me till the end, and I will share with you the leading account that over $95 billion billion dollars has been transferred into just this year alone. Let's dive in. Okay, so who is affected by these layoffs? According to usafacts.org, from January to March of 2024, there were 4.9 million layoffs that happened across various industries, and 1.2 million of that, to be exact, came from the professional and business services sector, which includes accounting, legal, architectural, engineering, and consulting services. Additionally, according to Business Insider, major companies like Meta, IBM, Google, and Microsoft implemented significant staff reductions this year. This isn't even taking into consideration what happened in 2023. In 2023, there was over 300,000 layoffs in the tech industry alone, according to data from layoff.fyi. And it wasn't just the tech industry. According to Forbes, industries like retail, manufacturing, and even healthcare have seen a significant uptick in job loss. And it's not just large corporations. Small businesses are feeling it too. And when you get laid off, it's stressful, no doubt. I've been there before. I got laid off from a job back in 2015 when I used to work in corporate America, and that's part of the reason why I transitioned into being a business owner today. But I'm sure you're trying to figure out how to navigate these next steps, and part of that includes figuring out what to do with your 401k. So let's take a look at your options. Okay, so when you leave your job, you'll have a few options on what to do with your 401k. First, you can simply just leave your money with your former employer. However, this is really going to limit your investment options, and most companies will only allow you to leave your money in the 401k plan if you're not employed there for so long. Now, also have to consider that if that company is doing layoffs, that might mean that your company is struggling a little bit financially. And if for whatever reason, if that company were to go under, your 401k has a chance of going too. It'll be very difficult to collect it if that company goes bankrupt. So kind of think of it like this. I'm sure you've dated somebody in the past, or have maybe wanted to. When you broke up with that person, did you leave your wallet, your car keys at your ex's house? Or did you go back and take everything with you? I want you to think of that exact same analogy when it comes to your 401k. When you break up or when you leave your company, you should go back and grab it and take everything with you. Another option you have is to roll your money over and into another qualified plan, like an IRA or possibly an FIA. Most traditional investment advisors are going to recommend that you roll your money from a 401k into an IRA to avoid any taxes or penalties. And while this is a really common move, it might not make the most sense for you. It just depends on a few things. For starters, IRAs still keep your money invested in the stock market. And if you weren't really familiar with it when you had a 401k, it's going to get even more complex when you roll into an IRA because you're going to get a lot more options to choose from when it comes to investments. And if you're not familiar with how to make those selections and you have to have an advisor attached to your account, now you're going to be paying advisory fees, which could just eat into the total value of your portfolio. So while IRAs might make sense for some people, you just need to understand how those accounts work and how it could affect you long term. Compared to an FIA, which is a fixed index annuity, which is basically an insurance contract that allows your money to grow and compound without any stock market risk. And according to LIMRA, FIA sales are skyrocketing this year. As of the third quarter, sales are up 56%, totaling $35.2 billion. And year to date, we're up 34% in FIA sales, totaling $95.1 billion with a B. If these trends continue, we're going to be looking at FIA sales crossing over $120 billion in 2024 alone. So how does an FIA work? Well, think of FIAs like bank CDs, but on steroids, meaning you have the chance to actually earn really good interest because FIAs track a stock market index of your choosing, like the S&P 500 or a NASDAQ, and how they work is they're going to give you the growth when the market does well, potentially up to a certain cap. But when the market goes negative, you don't lose any money because they give you a 0% floor. So you kind of get the best of both worlds. You get the growth, but without any of the risk. And there are completely fee-free options, meaning all of your money is growing and compounding and working for you, and you don't have to worry about paying fees or those high advisor commissions. And also, another really cool part is they have the ability to turn your 401k into a personal private pension, meaning you can take an income stream out of your 401k guaranteed to last you for as long as you live. Now, it's important to note that FIAs are similar to bank CDs, meaning they are a contract. So your money would need to stay with that FIA company for a certain amount of time. This is why I always recommend, if you are looking into these accounts, you want to connect with a licensed financial professional that is well trained on how to set and structure these plans for their clients. Now let's check out an example. Let's say a 45-year-old male gets laid off with $500,000 in his 401k, and he decides to roll that over into an FIA, earning an average 8% rate of return over time. By age 65, he's estimated to have an account balance of $2.259 million. And if he starts taking out income to live off of in retirement, he's estimated to take out $135,000, and that number is increasing every single year. By the time he turns 90, he's estimated to take out over $205,000 a year, with a remaining account balance estimated at $3.246 million. Now, here's the thing. Not all 401ks are actually eligible to be rolled over. So if you've been laid off or you've changed jobs, the very first thing you need to do is to call up the investment company that has your 401k and ask them if your money is eligible to be rolled over. Now remember, time is of the essence when it comes to your retirement savings. Choosing the right account at the right time allows you to maintain control over your financial future. And remember too, not everybody's situation is the same. We're all unique. So what might work for one individual may not work for another. That is why it's so important that when you're finally ready to take this next step, that you sit down and consult with a licensed financial professional to help navigate you through the different factors that you could be experiencing. If you live in the United States and you'd like to work with me or my team, we'd be happy to have a conversation with you. You can click the link in my bio to schedule a complimentary client consultation with us. I hope you like this video. If you do, please share this with anyone you can think of that is unfortunately going through a layoff or recently changed jobs or even just getting close to retirement. These are things everybody in those situations need to know. And if you want to see more videos just like this, hit that like button and click subscribe so you can get notified when my next video comes out, because I release a new video every single week and I would not want you to miss it. I hope again this helped you. Drop a comment below what you liked and learned, and I look forward to seeing you back here next week on YouTube.